that introduction, let me begin. As I was kind of mentioned in the email introduction, we would talk a little bit about 2019, what were some of the important factors going on last year, and then just thoughts about the year that we've begun and the months ahead. So 2019, probably not a big shock to everyone. The stock market surged last year, with the S&P 500 gaining 31%, and most of the other indexes also posted remarkable gains. This despite economic conditions that were rather tepid, with growth just over 2% and profits basically flat with very minor gains. So I kind of visualize or describe 2019 as a victory of optimism over reality. So great year for the stock market, not that much going on the earnings side. So as a result of that, the price to earnings ratio that everyone talks so much about stocks rose pretty substantially. And as I've talked about in earlier calls or when I've met with so many of you, really, to our way of thinking, the price to earnings ratio is really nothing but a measure of optimism about future earnings and dividends. So a big rise in optimism last year. So we really need to think about, well, what caused this most recent surge in optimism and ponder if it could be reversed, and would that cause the stock market rally itself to reverse? So thinking about the optimism. Now, there were certainly several positive developments last year, most notably the continued growth of the U.S. economy, the ceasefire and the trade hostilities with China. But it was really the 3 interest rate cuts in 2019 that seemed to truly impact and ignite investor optimism. Inflation has remained low, the flood of money searching safe investments has only grown, and the Fed and other central bankers were thus willing and able to lower interest rates with abandon. And so we do identify the Federal Reserve easing as the primary impetus of the stock market gains last year, and kind of as a corollary to that, just a continued faith and belief in that the Federal Reserve, I don't want to say omniscient, but certainly has their hands on the lever of the economy and are making the best decisions. So with those kind of brief thoughts about 2019, now just turn to thinking about 2020 and what could short-circuit things, or I guess you could say, well, what could really keep the party going? So since we credited interest rate cuts with the surge in 2019, well, what about the possibility of interest rate increases? And honestly, there's really no prospect of these in 2020. Inflation remains remarkably low, and with economic growth slowing in most parts of the world, there's little prospect of interest rate increases. So we have to assign this a low probability risk for 2020. Well, how about the risk that investors would just lose confidence in central banks and their ability to affect asset prices? Now, this would certainly have a huge and honestly catastrophic impact on the markets, but its probability, certainly for the near future, is minuscule. I'd almost call it 0 for 2020. Well, how about a recession? Seems like that could sink things. And it certainly is a possibility. Japan is already in one, and growth in Germany is flatlining. Growth in the U.S. is barely at 2%, while we're running an astronomical budget deficit. Nevertheless, growth continues on. Unemployment's very low. Housing markets are strong. Consumer confidence is high. And also, I think we even have to think about, well, what would the response be to an economic downturn? Guess what? More interest rate cuts. And nothing seems to juice the stock market like interest rate cuts, no matter what's going on in the so-called real economy. So I guess overall, although there is a non-zero chance of a recession, we don't really see a huge stock market risk from this eventuality in 2020. So still thrashing around for reasons that could really impact things. Certainly politics and the election, could that have a major impact on things. Certainly a non-zero possibility of a radical realignment of the political landscape. But it just seems we're talking about too much of a fundamental shift in the balance of power between these handful of corporations and governments. And it just doesn't appear to be a high probability event for 2020. So where does all this prognostication, semi-prognostication, assessment of current conditions, where does all this leave us? Our thoughts that there's no reason for panic or to fear an imminent crash, but we do have asset classes at extreme levels of valuation, and that is at a minimum cause for concern. And complacency or excessive optimism is always a cause for concern. So please indulge me with a few numbers here, but I do think they tell some interesting stories and kind of tie in with what we're talking about with valuation. So American stocks, let's start with those. Overvalued by most measures. The price to earnings ratio for the entire S&P is 19 compared to a long-term average in the 14 to 15 range. Something even more interesting about that is there's really 6 companies that make up 20% of the S&P 500, which is an extremely high concentration. And the price to earnings of those 6 companies, 35. So talk about optimism run rampant. There it is. Okay, so that's a real quick look at stocks. Well, how about bonds? They must be safer, right? So bonds are perhaps even more overvalued. We have a situation where the 10-year Treasury bond has a real yield, the rate of interest minus inflation, it's negative. So that's almost a guaranteed loss from buying a 10-year bond. One of the few times since 1950 that this has occurred. And as extreme as it seems to be in the US, it's not only here. So for me, the most salient example of that is investors who want to loan Greece money for 10 years, they receive an interest rate below 1%. If you can find a better example of excessive optimism than that. So we're talking about a country whose debt load is the highest in Europe, and it's barely improved its situation since its de facto default a few years ago. 10-year loan, 1%. So how are we at the family firm when we trying to cope with all these conditions and really just kind of help our clients, get through whatever times are ahead? Well, one is with, reasonable expectations about the future, and we certainly try to incorporate that into our projections. But even just taking a step back, I kind of think of it as, in terms of the management, is we don't want to panic, but we do want to have a healthy dose of conservatism and pragmatism. So emphasize asset classes or even segments of asset classes that aren't at those extremely expensive levels. And as always, being conscious of risk, whether that comes from economic or non-economic sources. And last but foremost, remaining very diversified, as once we're very 100% sure that events will occur that will catch everyone by surprise and humble any and all prognosticators, including myself. So with that, we'd love to enable your microphones, your phones, and just to hear any thoughts, questions, insights that you have.
This is Yurata. I just don't know what all that means. So what's the consequence of all that?
Do the best we can, all of us together, to, keep the balanced investment plan. Definitely don't try to get too sure of ourselves that we know what's going to happen tomorrow. But take a look at, the prices of the different assets. And if certain assets make a lot less sense than they normally would, then try to downplay them. And if other assets or investment classes have been sort of overlooked, by investors over the years, and especially over the past few years, put a little bit more emphasis on those, but not just to, try to avoid just riding the expensive markets higher without rebalancing, if we just want to, use the word, which is to, sell high and buy low. There's not too much that's low, but there are certainly some asset classes, maybe perhaps more in the international area or some areas of the bond world that are just not as extraordinarily as expensive as some of those that I did talk about.
Okay. I have to think about this. Thank you.
I mean, as I said, those, those six stocks that make up so much of the American stock market, and all just these household names that we think of all the time. And if they're selling at prices that are 3 times higher than a typical stock, I just think we should be leery of those. And it's, and just, I don't want to say take the consequences of that, but just recognize that, in general, assets that are very expensively priced are likely to, not do as well in the future without, just kind of looking at the weight of history and just kind of common sense that whether we call it Amazon or Google or Facebook or Netflix, they cannot grow at astronomical rates indefinitely. Something will happen. It always has. It's common sense that it will. And there'll be times where you can buy really good companies at fair prices, or the overall stock market will be priced fairly. And, in the meantime, if there's less risky places to hang out, that makes a lot of sense.
Okie doke.
Thank you.
This is Ed out in California. You mentioned the election this year. You mentioned the interest rates and the Fed. Are there other major factors, possible major factors, to affect the market? Maybe this virus in China? I don't know. What else?
Yeah. Hi, Ed. Thanks for that. Yeah, it's definitely, it seems like perhaps the markets are being too complacent, but certainly right now they've kind of shrugged off the effects of the virus, with, I guess, maybe the thinking being, well, even if people have to stay quarantined for a while, or even if, China really has a terrible 3 to 6 months of economic results, that in the end, we would emerge from it, of course, and then people would just go and buy the things that they had postponed for this time period. The election, certainly, it's possible that a candidate could win who would really want to take on the extremely pro-investor and pro-business environment that we have now. We'll probably have plenty of time to see that happen, I guess, as things start to unfold. Obviously, right now, I guess the markets, I'm just talking about from an investment point of view, are fairly sanguine that kind of challenge to this current paradigm will not happen as a result of the election. So it seems like there is, I don't want to say complacency, but kind of a belief that the worst from an investor standpoint won't happen. If I just think off the top of my head, and your question always reminds me of some thoughts that I've had kicking around, and I guess it's possible as a result of the impeachment trial and its outcome that, the president or the trade authorities could feel emboldened to really take on some countries, whether friends or foe, in a very confrontational way on the trade front. That doesn't seem very likely as we're heading into an election year. And even as it was happening in 2018 and most of 2019, it really didn't seem to have that much of an impact on the overall situation. Companies were able to continue to source their costs and source their sales in ways that made a lot of sense. And the various tariffs and things like that did not have a huge impact on shutting down the economy. You have to say it was an interesting question or thought about the latest virus, because it does seem, just from a common sense standpoint, that it should have had more of an impact than this. And sometimes it seems that somehow they're usually right, but that the stock market seems to anticipate and know things that haven't gotten to the World Health Organization and things like that. And they, even from the very beginning, the stock markets didn't react that sharply. And now as we see, well, the number of new occurrences is dropping off fairly regularly, is kind of would have been predicted. So I hope, that the investing outlook towards it was correct, as it seems to be. But again, we really don't know what will happen.
Actually, its virulency is probably going up. Latest statistics, it looks like.
Okay. Would you mind sharing where you saw that? Because I didn't see that.
Oh, no, you just can do this math for yourself. If you just take the ratio of the latest numbers that China's reporting, and there is a reason to be suspect about those, and then divide the number of deaths over time. It was first reported, it was about 2%, but the latest numbers seem to be more than 2%. Rather than 1 in 50, it's 1 in 40. Okay, so it really, it's just not clear how it's playing out right now. At least this is what I get from the stuff I've seen out of the CDC and some of the stuff I've seen at the Smithsonian. It's not really sure how it's playing out yet. It's not. China is declaring that in the non-highly contagious areas, it's decreasing, that the number of cases are diminishing, although there's at least 3 provinces where it's at least as intensely still in quarantine as it was before. So I would say the last I heard, actually I was just talking to a virologist today, is that it's really very murky yet what's going to happen there. They haven't even really fully identified, although they now think it's a pangolin, they haven't even identified fully the intermediary animal, and there's a lot of other standard epidemiological stuff that still has to get worked out. But anyway, that was from just stuff I was talking to with some people at the Smithsonian today, and some stuff I've read from the CDC.
Well, great, Urate. Thanks for sharing that with us. We appreciate it.
Oh, you're welcome.
The creature I heard about recently is bats. Bats.
Oh, bats are the reservoir hosts, but those are out in the wild. And then the way it gets from bats to the human population is usually through an intermediary animal. So they, in the case of SARS, it was the civets, those little civets of that, and then in the case of MERS, it was a camel. So the intermediary animal that they think is in this case is the pangolin, but they haven't fully identified it. And when they bring in animals from the wildlife markets into the city, is when the outbreak then occurs among the human population, when the crossover occurs. So yeah, so bats are probably the original host, or the relic host. And bats are innocent bystanders in the whole case. It just happens that their immune systems are such that they're not affected by all these viruses that are living in them. I mean, we all have stuff living on us that we're not even aware of. But when they shed it through pooping or peeing or whatever they're doing in the wild, and another intermediary animal picks them up and then brings it into an area of human population, that's when the outbreak occurs. So. But pangolins are thought to be the best guess at this point from some of the DNA work is that it's a pangolin. But they don't know yet 100% yet.
Thank you.
But yes, coronaviruses are definitely sheltered by bats. Bats have been host for them for a long time. Yeah.
Hmm.
But with the other coronaviruses, it's just another. The coronavirus that's most common that affects people. It's the common cold. That's a coronavirus.
Right.
One of the family. So.
Yes, I know we're not supposed to call this the coronavirus. It's COVID-19, I guess.
Well, that's a specific name. Coronavirus is a family of
Right.
viruses, and there's several hundred, if not over 1,000 of that family, and only 6 of that family are known at this point to be harmful to humans. And the 3 that seem to be most lethal are the MERS and the SARS, and now COVID-19. But common cold is one that we get all the time, and that is a coronavirus. It's of that family.
Mm-hmm.
Sorry, that's just a little bit of science I'd have from the Smithsonian because I work in that hall.
Anyone have any economic, other financial questions, insights to share?
What about Twitter? How come Twitter isn't breaking this? Isn't doing better? That's what I want to know.
That's that one's above my pay grade. I mean, it's just very difficult competition. It's all about selling advertisements and things like that, and
But that's okay. It's just a curiosity. Mm-hmm.
Mm-hmm. I understand. Okay, well, thank you everyone for your indulgence of my, stuttering and stammering. But I really want to thank you, Rate, too, for sharing so much knowledge with us. I really appreciate it. And even for those who, well, I guess if anyone would like to come back and listen to the call again, or we'll eventually share it up on our website, and we'll just send another email around with the link to it. In the meantime, we'll do our best via the blog, or I do on my LinkedIn, just to continue to keep you apprised of anything that we're thinking about, and certainly if there would be any, reason for us to reconsider or alter from the kind of philosophy that I outlined tonight, we'll certainly share that with everyone, probably on an individual level. But it seems to be working, and it's worked over the past 10, 15, 20 years. This kind of very healthy skepticism, and certainly I don't say avoidance, but the underweighting of more expensive investments seems to be a very good long-term strategy. So I think, our intent is to continue to do that. Although we look forward to the day where there are some more attractively priced investments and some fewer overpriced ones. That'll be very exciting.
Okay.
So again, thank you to everyone, and we will be in touch soon.
Thank you, Dave.
Thank you.
Thanks. Thank you.